Inflation is sky high, interest rates are low, and real returns on bonds have been trending downward. Should you continue to hold bonds in your portfolio? Stay tuned. Okay, Anthony, with, again, interest rates being so low, inflation being high, real returns on bonds have been trending negative. I think it has a lot of people, at least that are paying attention to this stuff, are bonds still worth investing in? Should I still consider them?
Right.
What are the traditional use cases for bonds?
Typically, investors want to hold bonds for stability because they're a good offset with stocks, and then to provide income, right? And so even if it's not from the actual interest yield from bonds, because it's so low right now, still having that stability to be able to sell bonds and produce the right amount of income is really helpful.
Now, again, I think Ben Carlson, what he's written, and we really like that. It's basically, a bad day in stocks is like a bad year in bonds. So the two are so different, and bonds really provide that stability that a lot of people need.
Right, and that's why still owning bonds can be worth it, especially when you're offsetting that, you're coordinating that with a stock portfolio.
Now, you've written a post, again, a while ago, basically, are bonds still worth investing in, which we will post, because this can get a little nuanced, right? How you want to be thoughtfully allocating to bonds, the type of bonds, because there's a wide gamut of bonds that you can invest in, et cetera. So here's another question, though. Is the current environment that we're in, right, low interest rates, high inflation, is this common? Have we seen this stuff before, or is this more of an outlier, meaning is this time truly different?
Right. Well, first let's address the negative returns, because if you look at 2021, bonds were down 1.5% when you just look at the overall bond market. Okay. Now, like you said, there's lots of nuance to that. If you go into U.S. Treasury bonds, it was down about 4.5%, which is meaningful, especially if inflation's up around 6 or 7%. Sure. So the real returns are low. To answer the question, though, is it different just from a return standpoint? The answer is no. I pulled out some statistics here. If you look at U.S. Treasury bonds, very recently in 2013, down 9.1%. Okay, 2009, down 11.1%. In 1999, down 8%. 94, down 8%. So compare that to down 4%. Yeah, it's not very different when you compare it to those recent years.
Now, again, it's not completely different, but there are some subtle differences, such as like the trend that we might see.
Yeah. So let me show that, and this is where things may be different, right? Or at least from a recent standpoint. If you go back to the early '80s, okay, we were really in 4 decades of downward trending interest rates. So what does that mean? It means that as interest rates are coming down, it helps bonds appreciate.
Because bonds and interest rates are a bit like a teeter-totter, right? If you get that in your mind, right? As interest rates go up, returns on bonds typically go down, and vice versa.
Right. So we may be heading towards an environment more like the 50s and 60s, where interest rates are going up, and therefore puts downward pressure on bonds. So that's the real question: is are we in an upward trend here? That we don't know. We're at a very low environment, but people have also been saying that for a while, like, oh, we're going to head up on interest rates. Hasn't really happened except very recently.
Now, it's one thing to look at this very rationally, look at a long-term chart and say, oh, well, see here, this is how things played out. I'm a retiree, or I'm nearing retirement. This is all great and dandy, but what should we actually do about this?
Yeah, and it is worth asking those questions. So I'd say number one is consider your risk tolerance. So there are people that are out there going, well, I don't want to own bonds because they're going down and stocks are going up, and so therefore I'm going to sell all my bonds and put it in stocks. But that's opening up a whole new set of risk, actually a lot of risk, right? So you have to consider what you're going from and what you're going into, and why your objective of owning bonds in the first place. Number two is that you want to coordinate your investment plan with your financial plan. Where bonds are there for stability, even if they're going down, it's usually not quite as much, right, as stocks.
And mathematically, over time, we expect bonds to outperform cash.
Yeah, they should, right? And it may be a hard go of it in the meantime, but yeah, if you go to cash too, you're not earning anything. So aligning your investment plan with your financial plan. And then thirdly is really consider making minor adjustments as opposed to wholesale changes. Sometimes people think, well, if I need to make a change, I need to do all or nothing. And that's rarely the case. If you don't want to own as much bonds, that's fine. but just consider further diversification, maybe not totally get out of that. And that's where people have to look at their personal situation and hopefully go through that with their financial advisor.
Yeah, I mean, again, really big thing you said here is don't make these big wholesale changes, because ultimately that's how people blow themselves up and really derail their retirement, right? So again, if you enjoyed this video, please like and share so other people can see this, right? We want people to have a successful retirement. And part of that is navigating these different portfolio components, right? How much do I have in bonds? How much do I have in stocks? What's the right mix for my financial plan, and to make sure that I can have enough investment growth to continue my lifestyle. If you'd like to learn more, visit our website or give us a call. We'd love to talk with you.